Most people believe investing is about finding the next big winner, the next technology stock, the next booming sector, the next company that will double or triple in value. But history teaches a very different lesson. The greatest fortunes were not built by people who constantly chased what was hot. They were built by people who understood something much deeper. They understood how economic cycles work. They understood how money moves. And most importantly, they understood which assets survive when everything else begins to fail. Today, we're living through one of the most important transitions of our lifetime. Government debt levels are reaching historic highs. Interest rates remain unpredictable. Currencies around the world are losing purchasing power. Geopolitical tensions are reshaping global trade. And artificial intelligence is transforming industries faster than most people can comprehend. In periods like these, many investments that looked unstoppable suddenly reveal their weaknesses. What worked during the last decade may not work during the next. The winners of yesterday are not guaranteed to be the winners of tomorrow. And that's why this discussion matters. Because when major shifts happen, wealth doesn't simply disappear. It moves. It transfers from those who are unprepared to those who understand the changing environment. By the end of this video, you'll understand 4 investments that have repeatedly demonstrated the ability to survive economic storms, inflationary periods, recessions, market crashes, and even major geopolitical disruptions. These aren't exciting overnight riches. They're something much more valuable. They're foundations. And foundations are what survive when everything else begins to shake. Before we begin, take a moment to like this video and subscribe to the channel. Our goal is simple: help you understand how the world's biggest economic forces affect your money so you can make smarter long-term decisions. Now let's begin. The first thing we need to understand is that every investor faces the same challenge. The future is unknowable. Nobody knows exactly what markets will do next year. Nobody knows exactly where interest rates will go. Nobody knows which headlines will dominate the next decade. Yet despite this uncertainty, people constantly invest as though they know. They place enormous bets on a single outcome. They assume technology will always rise. They assume real estate will always rise. They assume stocks will always rise. History repeatedly proves otherwise. Every generation believes its favorite asset is different. Then reality reminds them that cycles never disappear. They simply change form. If you study financial history long enough, you discover something fascinating. Economic environments tend to rotate through a few recurring conditions: growth, recession, inflation, deflation, booms, busts. Every major investment performs differently under each condition. The challenge is not predicting which environment comes next. The challenge is owning assets that can survive all of them. That's where the first investment enters the picture. High-quality, productive businesses. Not speculative companies. Not businesses dependent on hype. Not businesses surviving on borrowed money. Productive businesses. The type that generate real cash flow, provide essential products, adapt to changing environments, and maintain competitive advantages over long periods. Throughout history, ownership of productive enterprises has remained one of the strongest methods of preserving and growing wealth. Why? Because businesses can adapt. When inflation rises, many businesses adjust prices. When technology changes, strong businesses innovate. When consumer behavior shifts, great companies evolve. Businesses represent human productivity, and human productivity remains one of the most powerful, wealth-generating forces ever created. However, not all businesses survive. That's an important distinction. The goal isn't owning everything. The goal is owning quality. History consistently rewards strong balance sheets, durable demand, and disciplined management. The second investment may surprise many people because it often becomes controversial during strong bull markets. Gold. For thousands of years, civilizations have changed. Empires have risen and fallen. Currencies have come and gone. Political systems have transformed. Yet gold continues to hold a unique position. Why? Because unlike paper currency, gold cannot be printed. It cannot be created by government decree. Its supply grows slowly. Its value is recognized globally. Many investors dismiss gold during periods of economic optimism. But gold's true purpose isn't maximizing returns during prosperity. Its purpose is preserving purchasing power during uncertainty. Think about that difference. People often judge assets by how much money they make. Smart investors also ask how much wealth they protect. When confidence in financial systems declines, gold frequently becomes a destination for capital seeking stability. It's not perfect. It experiences volatility. It goes through long periods of underperformance. But over centuries, its role has remained remarkably consistent. And when building resilience, consistency matters. The third investment is often misunderstood. Many people view it purely as an income-producing asset, but its value runs much deeper. Real assets, particularly productive real estate and essential infrastructure. Real assets occupy an important position because they provide utility. People need places to live. Businesses need places to operate. Communities need infrastructure. The physical world continues functioning regardless of market sentiment. That's an important distinction. Speculation depends on confidence. Utility depends on necessity. Necessity tends to endure. Throughout history, productive real assets have provided both income and inflation protection. As prices rise, rents and usage fees often rise over time as well. This creates a natural connection between the asset and the economic environment. However, location matters, quality matters, cash flow matters. The lesson isn't simply to buy real estate. The lesson is to own assets that provide enduring value. The fourth investment is perhaps the most important because it influences all the others. Cash and short-duration government securities. This may sound boring. Many investors dislike cash because it appears unproductive. But cash performs a critical function: optionality. Cash gives you flexibility. It allows you to act when others cannot. During market panics, opportunities appear. During recessions, opportunities appear. During liquidity crises, opportunities appear. The problem is that most investors enter these periods fully committed. They have no reserves, no flexibility, no dry powder. Cash may underperform during certain periods, but its strategic value becomes obvious when the unexpected occurs. It allows survival, and survival is the prerequisite for success. Now let's step back and examine what these four investments have in common. They're different, very different. Productive businesses thrive during growth. Gold often shines during uncertainty. Real assets can provide inflation protection. Cash creates flexibility during stress. Each responds differently to changing conditions. And that's exactly the point. The future is uncertain. Therefore, resilience comes from balance. The biggest investing mistake is believing one asset can solve every problem. History suggests otherwise. Different environments reward different assets. The most durable portfolios are not built around certainty. They're built around preparation. Imagine two investors. The first investor places nearly everything into one idea, one sector, one prediction, one narrative. If that narrative proves correct, results may be spectacular. If it proves wrong, consequences can be severe. The second investor accepts uncertainty. They understand they cannot perfectly predict the future. Instead, they build around probabilities. They diversify across environments. They focus on survival first. Over long periods, the second approach repeatedly demonstrates its strength. Not because it's exciting, because it's durable. And durability compounds. One of the most misunderstood concepts in investing is the importance of avoiding catastrophic losses. People obsess over gains, but avoiding devastating losses often matters more. A 50% decline requires a 100% gain just to recover. A 75% decline requires a 300% gain. The mathematics become unforgiving. That's why wealth preservation deserves far more attention than it receives. The greatest investors think differently. They ask, what could go wrong? How exposed am I? What happens if my assumptions fail? These questions are not signs of pessimism, they're signs of realism. The future will always contain surprises. The goal is not eliminating risk, the goal is surviving it. And that's what these 4 investments help accomplish. Not because they're guaranteed winners, nothing is, but because they represent different responses to different economic realities. As we move into the coming decade, investors will likely face challenges unlike those of the previous generation. Debt burdens are larger, demographic shifts are accelerating, technology is reshaping labor markets, global power structures continue evolving. These forces will create both opportunities and risks. The investors who succeed won't necessarily be the smartest, they'll be the most adaptable. They'll understand that wealth preservation and wealth creation are partners, not competitors. They'll avoid becoming emotionally attached to a single outcome, and they'll focus on building portfolios capable of weathering many storms. That's the lesson history teaches again and again. The future belongs not to those who predict perfectly, it belongs to those who prepare intelligently. Because when uncertainty rises, resilience becomes a competitive advantage. And when resilience is combined with patience, discipline, and long-term thinking, extraordinary outcomes become possible. The world will continue changing. Markets will continue surprising people. New opportunities will emerge. New risks will emerge. But the principles remain remarkably consistent. Own productive assets, protect purchasing power, maintain flexibility, prepare for multiple outcomes. Those ideas have survived countless cycles, and they will likely survive many more. If you found value in this discussion, make sure to like the video and subscribe to the channel. Share your thoughts in the comments below. Which of these 4 investments do you believe will be the strongest over the next decade? I'd love to hear your perspective. Thank you for watching, and I'll see you in the next video.